Good afternoon, Master. First of all, I'll introduce you to the team. This is Don.
How are you doing?
Hi, Master. Nice to meet you.
This is Tamimi.
Nice to meet you.
This is Ahmed. If you'd like to take a seat, we can proceed.
First of all, could you briefly tell me what are we going to discuss today, please?
Yeah, of course I can. So today we're going to look at the objectives that we set at the beginning of the period. We're going to look at our performance in terms of risk and return, analysing how we manage and measure risk. We're going to look at our different analysis techniques with a summary of performance at the end and also a group reflection to conclude. So looking at the objectives, I'm pleased to announce that we achieved all the objectives. We finished top of the Champions League, beating the benchmark fund. Throughout the whole game, we promoted identical entities and over doubled the target return that was set at the beginning.
Oh, I'm excited to discuss all of this. Shall we start with our return, please?
Yeah, so looking at our performance, we made a nominal return of 16.28%, which in real terms equates to 12.7% when we take into account inflation. Looking more closely at our position in the league table, we had an average position of 5.3. If we eliminate the first week of trading, where we finished bottom, this position will be increased to second or third.
Well done, we have done a good job in here. I've heard the return is only the one side of the story investment world. Can you talk about the risk, please, you have taken?
Yeah, so we have to measure risks constantly. We measure this via standard deviation, Jensen ratios, training ratios. What I'd like to do now is invite Don to take the stage and explain that in a little bit more detail for you.
Thank you, Billy. As Billy has said, our standard deviation, the total risk, basically comprises of two kinds of risk. One is specific risk, the risk that we can actually control through diversification. And the other risk is market risk, which nobody has got control over. As you can see, according to coefficient of determination, our return is basically be determined through market risk, because it's mainly like 87% in there. So what it basically means is we've reduced our specific risk through diversification as much as we could.
Is the standard deviation the only risk measurement you have used?
Not at all, Masdi. We've used some other techniques such as Sharpe ratio and trainer, which basically tells you for every unit of risk that you have taken, have you achieved anything more than your risk-free rate? Because basically risk-free rate is the rate that everybody is entitled to. And here, as long as it hits the 1% mark, we are on the right track. So by 20th of March and by 16th of March, we've achieved beyond 1%. So we have actually reduced your risk as well. Going into Jensen, which is the most important of all, which basically tracks our performances against our benchmark fund, which is FTSE All Share Index. I'm pleased to announce by 16th of March 2013, we have beaten by 2%, and which is, I believe, a phenomenal achievement, and we've done it consistently throughout the game as well.
That's fantastic. You know that I'm undergraduate student as well. Now that you have talked about the risk measurement, why we don't talk about the strategy you have used in here?
Yeah, I'd like to jump in there, Ashley. So we have many different risk management techniques, such as pound cost averaging, and timing is very crucial when minimising risk. We explored all the terms on StockTrack, making use of all the different facilities available on there. Probably the most important factor is diversification. What I'd now like to do is invite Tamimi to talk to you a little bit more about pound cost averaging.
Okay. Yes, thank you, Billy. Since we care about the biggest loss in your portfolio and we need to reduce the risk as much as we can, we implemented the pound cost averaging to reduce the risk. For example, we have RDS company. We bought this company twice. We made two transactions, 250 shares at 21 and 40p. Then when the performance of RDS went down, we decided to buy more. So we bought 275 shares. So we come up with a weighted average price for the whole quantity, 525, around £21 and 11p. Then when the performance went up, we decided to sell. So we made a profit around 43 and 50p. But we did use the same thing with the Debenhams. But the performance of Debenhams is getting worse and worse, because we bought 8,000 and the performance of Debenhams went down. So we bought more. But I think still the performance of Debenham is getting bad. So we decided to minimize your loss as much as we can, but we made a loss in Debenham's £860.
Oh my God, that's a huge loss. Have you used this strategy somewhere else?
Well, basically we did use this 10 times. 8 out of 10, it works. So the successful rate for us is 80%. And by using this method, we are trying to reduce your loss as much as we can. But this is not only the risk measurement we did use. We use another tactics and strategy. So I would like to pass it to Don. He will tell you more about this.
Okay.
Thank you, Tomeme. As you can appreciate, in the investment world, getting the timing right is absolutely crucial. For that to happen, we've been constantly monitoring share price and patterns in London Stock Exchange. With regards to resistance level and supporting level, it's been statistically proved whenever a share price hits supporting level, there's a more chance that share price is going to go upwards. At that point, we've decided to purchase that price. The resistance is the other way around. Whenever it hits, there's more chance it's going to go down. So at that point, we've actually sold your shares. In that way, we've actually maximized your returns as well.
That's good.
When it comes to StockTrack, the simulated software that we've been provided, we've started with the market price. Whatever the price they offered, we've actually purchased at that price. But when we went along, we've realized there are some other facilities that they can exploit as well. Things like limit. If a share is not doing very well at the moment, at a certain time, then we can actually limit their losses. And also stop and sell. You fix a price and that share will be sold at that certain price with no involvement from you whatsoever. But the most important stuff is the trailing option. That basically says that you can put a price or a certain percentage. Whenever share price is going to go up, it doesn't do anything. It'll let it go away. However, when it starts coming back, starts selling all those shares. So all in all, what it basically does is maximizing returns for the money that we have invested in. Over to you, Billy, to continue.
Yes, thank you very much, Don. So the final and probably most important part of risk management is diversification. Now, we've diversified into many different investment vehicles, such as shares, investment trusts, mutual funds, bonds. The aim of this is to minimise the unique risk of any one investment, so it has minimal effect on the portfolio as a whole. One of the things that we noticed is that when the stock market was performing poorly, things like gold prices seem to perform well. So having a mixture of both of those in the portfolio means that we always have a positive investment in there at all times for you.
Look at this graph. It seems just it's all shares. It's not well diversified. Most of it is shares.
Right, okay, I agree with what you're saying. The portfolio was predominantly shares. The reason for that is due to the size of the investment that you gave us. There is only so much diversification that we can do. Within the shares sector, we diversified into different business sectors such as pharmaceutical, construction, travel. So in that way, we did diversify. As mentioned, with the size of your investment, there is only so much we can do in terms of how many countries and things we can enter. So to overcome this problem, what we did is we invested in investment trusts. Now what they do is they take a pool of investment from many different investors and they then invest that for you into different countries, different business sectors. So in effect, it automatically diversifies your portfolio. In regards to the bonds, before we took out any bond, we checked them on websites such as Moody to check that the rating was good and it was a sound investment for yourself.
By the way, I've heard there are two basic strategy fund management used. Please tell me which one you have used in here.
Yeah, that's no problem, Master. So we adopted an active strategy approach, which means constant management and control over the portfolio. We've demonstrated this by making the maximum number of trades within the period. The next aspect is commercial awareness. Every team member was constantly monitoring newspapers, websites, keeping an eye on tips for shares and investments.
That's good.
Once we got these tips, we then looked at the company ourselves. Every investment that we selected undergoes a thorough fundamental and technical analysis before we decide to invest. What I'd now like to do is pass you back to Don, who's going to first of all run you through fundamental analysis techniques.
Thank you, Billy. Thanks for the opportunity. First of all, let me tell you, fundamental analysis normally doesn't believe in chartism or chartist techniques, basically. However, this is an exception. As you can see in here, we got two leading companies, ABF and EasyJet. Those are the two companies we've bought time and time again and made a lot of profit as well. The first impression for us is they've got a nice upward smooth profit. So we've been impressed, to have a look in those companies in details. As fundamental analysis, I just had a look at with profitability ratios to start with. The leading ratio, ROCE, the ROCE, from 2008 to 2012, for every pound you've invested in, how much return you are going to get. Yes, it's been consistent, it's on a nice upward track. Yes, profitability-wise, this company has done really well. Asset turnover, it's a part of ROCE as well. It's a sort of efficiency ratio, if you like. For every pound you've invested in capital, how much sales or how much revenue you're going to get generated. Yeah, for every pound you've invested in 2008, you're going to get £1.30 around. And when it goes to 2012, it's been going upwards up to £1.61. So that actually tells us this company in terms of profitability has been doing very well. However, in the investment world, especially in the corporate sector, they are more interested in maximizing shareholders' wealth. So the shareholders' perception about this company going forward is reflected in PE ratio. So from 2008 to 2012, it's been so consistent. It's always in 40s and 15 as well. So shareholders are more than willing to invest in this company. They must be happy. In terms of dividend growth and total shareholder return, basically comprises of your dividend as an income and your capital growth as well. From 2008 to 2012, there's a nice consistent dividend growth from about 6.44%. And also the total shareholder return is, yes, it is a bit up and down. However, they are bounced back in 2012. It's giving you a return of 19.74, which is not bad at all. And earning per share tells actually the same story like PE ratio. They are gaining more returns for the shares that they have invested in as well. So that means at that point we said, okay, it's absolutely fine to invest in them. However, to be in the safe side, we've always had a look at in financial risk as well. Are they highly geared? Not at all. From 2008, they are somewhere around 19%. And that gearing ratio has gone down to 15% in 2012. What it means is basically you've got a lot more capacity to generate a lot more capital in case you need it. And then you've got enough operating profit as indicated by interest cover. The standard gearing, the interest cover is three times, but this company has got nearly 8 times. So there's no financial risk, comparatively speaking, whatsoever. At that point, we've decided to invest in those companies, and it's not just these 2 companies. We invested the same methodology for every other company as well.
Okay, and that's good, but I've got interesting questions. How do I know you've managed my funds effectively and diversify better than the tracker?
Over to you, Ahmed.
Hi Majdi, I will take you some of conclusions that we have implemented, starting with the beta. We've calculated, as we all know, beta is a key component of capital asset pricing models, which calculate the cost of equity. The higher the beta, the more expensive the stock became. As shown here that we've used beta as a focal point to judge the level of the level of the risk that our portfolio has. As showing here that the betas in different stages are almost 1%, so we are reflecting the market more or less. For example, if the market claims by 5%, our portfolio will claim by almost the same percentage. Moving to the second part of calculation, we've calculated the specific risk of our portfolio, also in different stages, starting with 29th of November. Our portfolio risk, the black colors are less than the individual shares that we have got. This is because the diversification that we have implemented.
Yeah.
Moving to another dates, we have calculated the specific risk also on 19th of Jan and 16th of March, and it also less than the individual shares that we've got. This is also because the diversification that we've got. Moving to the final part, we've compared our actual return with the benchmark in FTSE All Share Index, starting in different stages. Starting with 29th of November, we've gained 1.8%. But on 19th of Jan, we've made not a loss. We've compared our actual return with the benchmark, and we've made a loss because of the Christmas event. But we get back on the track on 19th of March with 2.3%.
Okay. Interesting. It seemed like you have invested in many different shares. Talk me through one strategy you have used to convince you have invested in the right time.
Pass it over to Tamimi.
and he will
Thank you, Ahmed. Well, basically, since we concerned about the right time to invest your money,
yeah.
the point here we did implement a combination models between the growth model and CAPAM to decide if this company is suitable and a good decision to invest in. So, for example, with the Vodafone company, we did use a growth model and the cost of equity, which is CAPAM model, and we made a calculation to come up with a suitable price, and we've got £1.64p. This price is still under the market price, so that means it's undervalued, so that means it's good to invest in this company. But we did use the same method with HL company, but we got a different figures here. We got a negative one, and that because the cost of equity is less than the growth model. So we decided to look for another strategy. That's it.
Okay, I'm full of calculation now, almost exhausted. You know what? I'm more interested in technical analysis, as it's more easy to digest. How have you used any, if I don't mind to ask?
Yeah, I'll answer that one for you, Masty. So here we have technical analysis. This is one of the techniques used called chartism. Basically, it's looking for trends using historical data. Here we have the past 3 years' share price for Imperial Tobacco. These circles highlight the same period in January every year. As you can see, there is a big drop in share price each time. When January 2013 came round, we were constantly monitoring the share price. On the 18th of January, there was a dip in share price of 5% in one day, which then continued to drop by a further 2 to 3% over the next few days. Once the share price had levelled out, we decided to purchase into this company. Now, unfortunately, after we purchased, the share price did drop slightly, so we implemented the pound cost averaging technique that Tamimi talked about earlier to lower the average share price. And I'm pleased to say that we were able to sell this company off at a profit of just over 2%.
That's good.
Now, moving on, one of the other techniques that we used is looking at candlesticks graphs. This is the natural gas price, which is a future that we purchased many times.
What's that blue line in there?
Yeah, so the blue line is the support level, which is all to do with this technique. What we're looking for is we're looking for these candlesticks to hit the support level. What that indicates to us is that once it hits it, the price of the natural gas is more likely to increase. On the other side, the second line that you see on the top there, that is the resistance level, which has the opposite effect. So when these candlesticks hit the resistance level, they are more likely to decrease in price, which indicates to us that we need to sell this share or natural gas. The second formation that we're looking for is double bottom Ws. Again, it uses the same concept using support level. What we're looking for here is we're looking for the formation of a W to hit the support level twice. That then indicates to us that the price is more likely to increase. As you can see, these yellow dots replicate times when we have purchased into the natural gas, all of which I'm pleased to say we sold off at a profit.
That's good.
On the flip side to this, the other one is the double-topped M, which is exactly the same concept, apart from flipped upside down, and it uses the resistance level, and it has the reverse effect, so if it's the other way around, it indicates to us that the price is likely to decrease, therefore we need to sell this share or future. Another formation technique that we used is Bollinger Bands. Again, this can be used on futures or shares. Here we have an example of Bovis Home Group, which is a company that we purchased many times. What we're looking for here is use a band of moving averages. So we use the candlesticks. When the candlesticks cross the upper band, that again indicates to us that the share price is likely to increase. And then we use the resistance level to decide when it's going to decrease, and that therefore when to sell the share. So if I could summarise the performance for you, Masty, here we have our profit for the period. As you can see, we've got a nice upward trend. The red line replicates the end of the period. Before the red line, we have an active strategy approach. So whenever there is a dip in the profitability, we were able to have a meeting and come up with a solution to rectify that problem. After the red line, we have a passive strategy. So as you can see here, there is a big dip. We were unable to come up with a solution because we didn't have a meeting. However, on the flip side, as you can see, the profit has remained relatively constant. This is because of the diversification that we've implemented for you.
Okay. Could you tell me what a return you gain from investing in different segments?
Yeah, I'd like to pass you to Don. He'll talk you through our pyramid of risk.
Thank you, Billy. According to your attitude to risk, in the investment world, when you take more risk, that means more return as well.
Yeah.
As can be implemented in here, can be depicted in here as well. For the futures, which has got the highest risk, obviously you've got a return of nearly 12% in there. When you compare it with the US Treasury bill, where you've got no risk whatsoever, however, the return, as you can imagine, is nearly 1%, which is not very good at all. The middle layer is basically telling you the middle kind of risk and middle kind of return as well. In total, it has given us 2.12%, which includes the investment trust, which Billy has talked about earlier, a return of nearly 4% as well.
Mm-hmm. That's brilliant. Is there any chance someone can talk about your whole experience, about your journey to success?
I'll take that opportunity as well, Mashde. First of all, it's been a pleasure working in with all these members, and they have come to the table with all these different skills, and they have gained quite a lot of knowledge and the practical exposure with regards to stock track as well. And they are from all different backgrounds. The cultural diversity has always come to the table, and we've shared our experience, our knowledge with each member as well. When it comes to investment decision, it was always a battle between risk seekers and risk averse. But that battle has worked wonders for us. We've made the right choices, we made the right decisions. As a result, we've become the leaders of the Champions leaderboard as well. So all in all, what I'm pleased to say is, King of Trade, that's us, delivered beyond expectations.